Welcome you all to the Accounting part of my YouTube channel, and I hope that you understood my previous lessons that we covered in our previous videos. So I hope these days you are getting prepared for your LL examination by practicing your past paper questions and other model paper questions as well. So I was continuing with the management accounting previously, but I had to skip that because number of students have requested from me to cover up the major or the tricky areas in company's final accounts. So I thought of coming back to the syllabus and to conduct 2-3 sessions over company's final accounts and finish it with a past paper question. So when it comes to the company's final accounts, as you know, at your accounting second paper, there will be a compulsory question from this lesson. So for that, you will be granted 20 marks, right? And for the first, the MCQ paper as well, they are testing 2-3 questions out of this lesson. So in order to get a flying color, in order to pass your accounting paper with an A pass, you have to score around 15 to 16 marks from your compulsory question. So it's really tricky, and it's bit time consuming as well. In order for you to get 15 to 16 marks, it takes much time, right? So you should practice this to minimize the time you spend at the examination to cover up this question, right? So when it comes to the company's final accounts, that lesson cannot be covered up within 2-3 sessions, 2-3 video sessions or 2-3 hours. So it's a big lesson. So as you know, when it comes to your school or your tuition class as well, they take around 1 or 2 months to cover up this whole lesson, right? So okay, let's try what we can do, and let's cover up the major areas of this lesson, and let's try with the past paper question as well. So then you can practice with the other past paper questions as well, right? So when it comes to the company's account, it's basically dealing with the accounting standards, right? So before moving on to the company's final accounts, before touching the company's final accounts, you have to have a good understanding about these accounting standards. There are other accounting standards as well, but when it comes to your A-level syllabus company's final accounts, these are the major frequently tested accounting standards, right? LKAS 1 accounting framework, and LKAS 2, that's for inventory. So today we are going to cover up LKAS 16. So that's for the property, plant and accounting for property, plant and equipment. So for your final accounts question, let's say there are 10 adjustments, so maybe 4 to 5 adjustments are coming from LKAS 16. So a lot of marks will be allocated from this lesson for your final accounts question, right? So today I'm going to conduct a lesson from LKAS 16, that is accounting for property, plant and equipment. Okay, so under property, plant and equipment, that's under LKAS 16, for your A-level examination, these are the areas you have to study. So initially, what do you mean by PPE, or what do you mean by property, plant and equipment? And then how we are going to acquire the property, plant and equipment, and how do you recognize the cost of your property, plant and equipment once you purchased or once you constructed. And then what's the purpose of having property, plant and equipment, and with the usage, how do you account it? Oh, as you know, with the usage of a property, plant and equipment, it depreciates, no? The wear and tear comes. Oh, with the usage, the value of the asset is going to be reduced. So how do you account for that? So we call it as depreciation. And then changes to the market price. So let's say a land, with the usage or with the passage of time, the value of the land, the market value of the land is going to be changed. So in that case, how do you account for changes in market prices? And then disposal. So you can dispose your asset, or you can sell off your asset if you want. So for that, how do you account it for? So those are the areas that you have to cover up, and those are the major areas will be tested from property, plant and equipment lesson at your annual examination. Okay. So before moving on to the accounting part, you have to have an understanding what do you mean by property, plant and equipment. So what do you mean by PPE? So as per the LKAS 16 accounting standard, there are two criteria to be covered to recognize a property, plant and equipment. So the first one is used in the production. So that means used in the production of goods or used in the supply of services. And the other one is expected to be used more than one period. So that asset you are going to use more than one period. Here the period is 12 months period. So that means an asset that is used in the production of goods or services, and that asset you are going to be used more than 1 year, right? So if we talk about the examples, when it comes to a brick manufacturing company, the machine or the equipment items used in the production of bricks, or when it comes to a bakery, delivery van is a property, plant and equipment, because we are using that asset for our production or to provide our service, and we are going to use that delivery van for more than 1 year of time. Let's think the other way. So when it comes to a car sale or a car dealer, so there may be a lot of motor cars with his business. So is it coming under property, plant and equipment? No, he is not going to use those motor vehicles for his business. For production of services or production of goods or services, and he is not going to keep those assets for at least for a 1 year period. No, right? He is going to sell. He is going to gain a return over selling those motor vehicles. So that is coming under his inventory. So that is coming under LKAS 2. So now you know. So now you know what do you mean by a property, plant and equipment, or PPE. So now you want to recognize those PPE items in your books of accounts. So now we have to check how we are going to recognize, or how we are going to account those property, plant and equipment items in your book. So as per the standard, so as per LKAS 16, property, plant and equipment items should be recognized only if it is probable that the future economic benefits of the asset will flow to the entity, and the cost of the asset can be measured reliably. So that's based on the technical terms. So let's say if you are unable to understand those things, simply when the asset is available for your use within the business, and if the cost of the asset can be measured reliably. Okay. So now we want to know what do you mean by the cost. So how we are going to recognize the asset? So as per the standard, it says your value or your initial recognition of your property, plant and equipment item should be based on your cost, right? So what do you mean by the cost? Cost includes, as per the standard, cost includes purchase price. So that's the amount you paid to the seller, right, to acquire that asset, and the non-refundable taxes like import duty or whatever the charges you pay to bring the asset to the present condition and present location. So simply, if I summarize these things, purchase cost plus all other expenses, all other cost incurred to bring the asset to the present condition and the present location. So those expenses, those costs to bring the asset to the present condition and present location includes non-refundable taxes and site preparation. So let's say you are going to acquire a big generator, so you cannot keep inside it your office, so you have to keep it separately from your office. So for that, for the protection of that generator machine, you have to build up a small building. So that's site preparation, and initial delivery or the handling charges and installation fees. So those costs, without those costs we cannot start usage of the asset, right? So those things, those expenses, those costs has to be incurred to bring the asset to the present condition and present location. So all those expenses should be added to your cost, and so that your initial recognition of your asset should be the collection of all those expenses. Okay, so the examiner is very much interested on this area, so the cost area. So in each year they are testing 1 or 2 questions from your MCQ paper regarding the PPE cost. So let's take 2018 past paper MCQ question. And the question number 16, right? The following information relates to a machine acquired by a company which is registered for value-added tax, right? That sentence is very much important. That company is registered for value-added tax. That means they can claim their VAT part, the VAT value-added tax which is paid at the time of purchasing something, can be refunded from the Inland Revenue Department, right? Date 1st April 2017, importing the machine including 15% VAT, 575, right? And transporting the machine to the company, 40. Preparing the site and installing the machine, conducting a test run and ensuring thereby that the machine is functioning properly, receiving cash from sale of items produced in the test run, conducting the opening ceremony. And you are tested the cost of the machine at recognition and the date of commencing depreciation of the machine as per LKAS 16. Right, let's calculate the cost. So the first one, importing the machine. So that's including VAT part as well, altogether 575. So now you have to remember what you learned. So you have to add only the non-refundable taxes. Here the VAT is a refundable tax because that company is registered for VAT. Therefore, they can claim whatever their VAT expense they pay at purchasing, at the time of purchasing from the Inland Revenue Department, right? So that means that VAT portion should be excluded from your property, plant and equipment item. So 575 is including that VAT part, so you have to divide it by 115 and multiply it by 100. Then only you can find the actual purchase cost of the item, right? And transporting the machine to the company, yes, it's a directly attributable cost. Without transporting, you cannot consume, you cannot start using that asset. So that 40 should be added. And then preparing the site and installing the machine, yes, installation charges and the site preparation charges should be added, 60. And conducting a test run and ensuring thereby that the machine is functioning properly. Yeah, test run should be functional, otherwise you cannot use the asset continuously. So that 80 should be added. And receiving cash from sale of items produced in the test run. So that's a byproduct. So you are selling the byproduct which is generated at the test run, right? That's actually an income. So you have to deduct that from your cost. So that 30 should be a deduction. And then conducting the opening ceremony. Yeah, it's not mandatory to conduct an opening ceremony to use that asset. So it should not be added to the cost of the asset. It's just an administration expense. So if we take the total, that should be 650. And they are testing, then they are asking the date of commencing depreciation. So on which date that asset is available for use. So that's after the conducting the test run, right? So that's 15th May 2017. So your answer should be answer number 2. Okay. So now you know what you mean by your property, plant and equipment and how the initial recognition should be done. So now let's talk about the depreciation. So what do you mean by the depreciation? So with the usage of the asset, the value of your asset is going to be reduced, right? So let's take a motor vehicle. So with the usage of your motor vehicle, the market value of the asset is going to be reduced. So that's an expense for the company. So you have to record the depreciation, right? So when it comes to a company, there are two methods of recognizing depreciation. So the first one is the straight line method and the reducing balance method. So if we take the definition of depreciation, it's the written down of depreciable amount over the economic lifetime of the asset. So what do you mean by the depreciable amount? So depreciable amount is the cost minus residual value or the scrap value. So what do you mean by the scrap value or the residual value? So in some assets, there may be a small amount which can be, that we can ensure this amount can be collected by selling the asset at the end of the useful lifetime of the asset, right? So let's take a motor vehicle. So we can assume, that company can assume at the end of the useful life of the asset, we can collect 100,000, right? So maybe we have purchased it for 1 million, but you can collect at least 100,000 by selling that asset at the end of the lifetime. So that's the scrap value. So the cost minus that scrap value, that's the depreciable amount. So what do you mean by the useful life or the lifetime of the asset? So it's just an estimation made by the company management. So that's the expected life that company is going to use that asset within the business. So that's very simple, right? Okay, so when it comes to depreciation, as I mentioned earlier, there are two methods: straight line method and reducing balance method. So these are the formulas that you have to use for when calculating the depreciation. So the first one is very much easy: cost minus residual amount. Residual amount will be given at the exam. Cost, you know how to calculate it, and divide by economic lifetime. So the economic lifetime will be provided. So this one minus this one divided by economic lifetime. So at every year you are getting the same amount of depreciation. So keep in your mind, if you use the straight line method, in every year you are charging as depreciation the same amount, right? If the economic lifetime is not given and a depreciation rate is only given, so you have to use this formula: cost into depreciation rate. So the straight line method is very simple. And the other one is reducing balance method. So I forgot to mention, these straight line method and the reducing balance method, the methods are policies, accounting policies adapted by the company. So those policies cannot be changed by the management as their wish. 1 year straight line method and the next year the reducing balance method and again a straight line method. We cannot do like that. So let's talk about that changes in policies in another session. So up to now, just keep in your mind, those policies cannot be changed as their wish frequently, right? If you adapt one policy, you have to continue with that policy until it's getting invalid, right? So the reducing balance method, from the meaning of the word, you can understand the balance is getting reduced or the depreciation charge is getting reduced. So that means with the usage of the asset or with the passage of the economic lifetime, the depreciation charge is getting decreased, right? Carrying value into depreciation rate. So what do you mean the carrying value? Carrying value is the cost minus the previous accumulated depreciation. So what do you mean by the accumulated depreciation? So that's the whole depreciation that we charged up to now. So cost minus the whole depreciation charge up to now is the carrying amount, right? So that's simply the today's value of the asset as per our books. So that into depreciation rate, right? So the double entry should be depreciation for the year is an expense. So depreciation charge, it should be debited to the depreciation account and accumulated depreciation should be credited, right? So the depreciation account debit, accumulated depreciation account credit. So that's how you are going to record depreciation. Okay, so let's move on to the subsequent recognition. So subsequent recognition is the recognition after the initial recognition. So every year we have to depreciate that asset and every year we are using that asset. So every year we have to reassess the value of our property, plant and equipment item. So that's we call the subsequent recognition. So as per the standard LKAS 16, there are two ways. There are two models to recognize the value of the PP item subsequently. So the first one is cost model. So that's the normal depreciation that you recognize at the initial recognition as well. So you have to record for depreciation and then next year as well you have to record for the next year depreciation, right? And second one is revaluation model. So this revaluation model is little bit complex for the students at the examination. So you are not going to revalue all the assets. So let's say you are having an asset, its market value is changed frequently. So it's volatile, it's highly volatile. The market value of the asset is highly volatile. Then you can adapt the revaluation policy. You can adapt the revaluation model for that asset. So that model, if you are going to adapt that revaluation model to that asset, the whole model should be added to the whole class of assets, right? So let's say for the total, you are having 10 lands in your balance sheet. In your statement of financial position, you are having 10 lands, right? So you cannot revalue only the Colombo land. You can revalue only the Kandy land, right? Whatever the 10 lands, you have to revalue even though their market values are not volatile, right? If you adapt that policy, you have to adapt that policy for the whole list of assets, right? Right. So that is for land. And let's say you are having another computers as well. So computers you can adapt the cost model, land revaluation model. So that's okay, that's allowed by the standard, right? So how we are going to revalue the asset? So normally when it comes to a company, revaluation is adapted basically for the lands, because the land value is going to be changed, because we cannot predict the land. So the value may be declined or the value may be highly increased with the passage of time, right? So we can adapt revaluation model for lands. So how we are going to adapt this revaluation model? So that revaluation you cannot do by your own, right? So if you are having a legal case, you have to consult a lawyer. Likewise, if you want to revalue your assets, you have to consult a professionally qualified revaluer. So there are some officers called professional revaluers. So you have to consult their support, and then those people comes to your land and they observe the market changes and observe the natural disasters or observe the environment of your land and other development of the area, and based on those factors they assess the value of your land. So that value should be your revaluation amount, right? So this revaluation can be made at a gain or can be made at a loss. So the accounting part of this revaluation is little bit tricky. So most of the students are going wrong for accounting for revaluation. So let's talk about that revaluation using small examples. Okay, so I took a small example using a land. So the first example is initial cost of land as at 1st April 2019 is 500,000, and then its revalued amount as at 31st March 2020 is 800,000. So land is not going to be not going to be depreciated. Why? So the useful life cannot be assessed for a land. So therefore we are not going to depreciate lands. Okay, just keep in your mind. So that has been tested frequently at the examination as well. So okay, initial value is 500,000 and it has been revalued up to 800,000. So the land opening balance should be 500,000, right? I will thousands here, and then the value of that asset at the end of the financial year should be 800,000, right? Okay, so it seems there's a gain of 300,000. So I put 300 here. Okay. So your revaluation gain is 300,000. So what should be the double entry? Okay, land account debit 300,000. That's okay. So we are to credit. So it should be a gain to your where. That's the most important point. You cannot credit it to your profit or loss statement because it's not a realized gain. Yes, true, it's a gain, but it's not realized. It's just a difference between the revalued amount and the cost. So revalued amount, how do you derive with that? So that revaluer comes to your place and he assesses a value. So based on his word only, you are going to recognize a gain on 300,000, and then you are going to credit it to your P&L and then arrive with a gain at the end of the financial year. So standard does not allow you to recognize the revaluation gains into your profit or loss statement, right? It's not an earned gain, it's not a realized gain. Therefore, we have to make a reserve. We have to make a capital account called revaluation reserve in order to transfer the credit entry. So we cannot transfer that credit entry to the profit or loss statement, whereas we have to transfer it to a revaluation reserve. So let's take another account called revaluation reserve. So we put that 300,000 here, right? So this is a capital account, and this account should be recognized in the statement of changes in equity statement, right? So what is the concept behind that? So that's the prudence concept. So I hope you have studied accounting concepts. So prudence concept says what? So it says whatever the expected expenses has to be recognized immediately, whereas whatever the expected gains or the unearned gains cannot be recognized as an income, right? That's based on the precautionary basis, right? So this is an unearned gain, therefore we are not going to recognize this income in your P&L, right? Okay, so let's take another example. So the initial cost of land as at 1st April 2019 is 500,000 and the revalued amount as at 31st March 2020 is 300,000. So let's take a T account for land. Opening balance is 500,000. I put it here. And the closing balance as at the end of the financial year should be 300,000. So now you can see there's a difference of 200,000 here. So it should be credited to the land account. So this has taken place at a loss. So the land has been revalued at a loss. So the land account is going to be credited. But when it comes to a revaluation gain of a land, the credit entry was posted to the revaluation reserve account. But here in this case the credit entry is posted to the land account. So now this is at a loss. So the debit entry should be posted to the, that's the important point. Previously, if it is a gain, we recognize it as a revaluation reserve. But here, if it is a loss, we have to recognize it in the P&L. So based on the prudence concept. So it says whatever the expected losses should be recognized immediately, right? So we charge it to the P&L. Under other expenses. So please keep in your mind those two examples that we discussed, that is only for the first time revaluations. So if it is a first time revaluation gain, the land account or the whatever the asset account should be debited, whereas the revaluation gain should be credited to a revaluation reserve account, right? So if it is an initial revaluation loss, the land or the whatever the asset account should be credited, whereas the revaluation loss should be charged to the other expenses. Okay, so that's really simple. And then let's check how we are going to account for revaluation where the asset has been revalued previously as well. So let's take an example. Okay, so this is the third example. Balance of land as at 1st April 2019, that is the balance of land at the start of the financial year, that is 500,000, and revalued amount as at 31st March 2020, that's the balance at the end of the financial year, that's 800,000. And it says previous year revaluation loss 100,000, right? So that means the company has revalued the land previously as well, and it has arrived with the revaluation loss previously. So what do you think about the accounting entry for the revaluation loss which was accounted last year? So as you know, if it is an initial revaluation loss, it should be charged to the P&L. So we know, so we can assume this 100,000 has been debited to the profit or loss statement previously. But this year there's a revaluation gain of 300,000, 500 to 800, there's a revaluation gain of 300,000. Let's check how we are going to account it for. Land account opening balance 500,000. At the end of the financial year, it becomes 800,000. Right? So that means there's a revaluation gain of 300,000. So it should be goes to a revaluation reserve account, right? But there's a revaluation loss of 100,000 that you had accounted previously. That 100,000 might have debited to the profit or loss statement under other expenses previously. So what you have to do is, in the current year, you have to set off this 100,000, right? So you have to charge up to the amount that you have expensed previously in your profit and loss statement, right? So I take P&L here. So last year there's a debit balance of 100,000, right? So this year what you are going to do is you have to set off that 100,000. That means you have to credit 100,000. So up to the amount only up to the amount that you have debited previously. So last year they have debited 100,000. Current year you have to credit 100,000 to the P&L in order to set off with that 100,000, right? So the balance gain, so the total gain is 300,000. So out of that 100,000 has been credited to the P&L. So the balance 200,000 should be charged to the revaluation reserve, right? So that's how you have to account it for. So double entry is land account debit 300,000, P&L account credit 100,000 and revaluation account credit 200,000. So there are three parts. Okay. So the fourth example, balance of land as at 1st April 2019 is 500,000 and the revalued amount as at the end of the financial year is 300,000. So as you see, there's a revaluation loss current year. So previous year revaluation gain is 100,000. So that means you have revalued that land initially in previous year. So you have arrived with a gain of 100,000. Let's check how we are going to account it for. So the land account is same as earlier. Land opening balance is 500. Closing balance should be 300. So that means there is a revaluation loss of 200,000. So the land account is credited. And let's check where it should be debited. So it says previous year revaluation gain is 100,000. So how you had accounted it previously? So if it is a revaluation gain, you might have created a revaluation reserve. So there is a balance of revaluation reserve account in the credit side, right? So let's track that. So there is a balance of 100,000 which you had posted previously. So there is a balance of 100,000 which you had accounted previously, right? So now current year there is a revaluation loss of 200,000, right? So if it is a loss, you know the total loss should be charged to the other expenses in the P&L. But here you can find a revaluation reserve as well. So you can charge this 200,000 to the revaluation reserve account up to the level of that revaluation account, revaluation reserve account, right? So there's a balance of 100,000 now. So you can set off that loss amount with this 100,000. So I put 100 here and there's a balance of another 100 now. So that's as the normal practice. So it should be goes to the other expenses. So this is how you have to account it, right? So the land account credit 200,000, revaluation reserve account debit 100,000 and other expenses debit as revaluation loss 100,000. So there are also three parts for the double entry. Okay, so that's all about the revaluation part and the subsequent recognition of the property, plant and equipment. At last we have to discuss the disposal of property, plant and equipment. So disposal is the selling off of your property, plant and equipment which you were using earlier. So once you dispose your asset, you have to remove that from your asset portfolio as well as the accumulated depreciation as well. So that disposal may take at a loss or a gain. So you have to account all those gains and losses as well. When it comes to the disposal of PPE, there are 5 steps to be followed. So if you could remember those 5 steps, you will not go wrong at the examination as well. So I write down those 5 steps here. Okay, so this is how we are going to put double entries for the disposal of property, plant and equipment. So the first one is remove cost. So the assets cost, the cost of the asset is reflected on the asset account. So if you are selling that asset, you have to remove the cost of the asset from the asset account. So for that, we are creating a temporary account called disposal account. So disposal account debit and asset account credit. So no longer that asset is existed in the fixed assets portfolio. And then remove accumulated depreciation. So that is only for the start of the financial year. So that means the accumulated depreciation for that asset only up to the starting date of the financial year. So in order to remove that, accumulated depreciation is having a credit balance. For that you have to debit it and disposal account credit. And then charge current year depreciation. So you may dispose the asset at the mid of the financial year, right? So the accumulated depreciation up to the financial year now has been removed. at the second step. So under third step, maybe you are using that asset for 6 months within the current financial year. So that depreciation should be an expense for your company, right? Until the disposal date. So the depreciation expense account debit and it should be charged to the P&L, and disposal account should be credited. Whereas if it is a normal depreciation expense debit, accumulated depreciation credit. Now we are not going to credit it to the accumulated depreciation, we are going to credit it to the disposal account. And fourth one, disposal proceed receipt. So you may receive cash after disposing the asset. So cash account debit, disposal account credit. And last one, record gain or loss. So you can calculate whether the disposal has taken place at a gain or a loss and record it as a gain or a loss. So let's take a small example and apply those 5 steps. Then you can easily understand what are those 5 steps. Okay. So here it is a small example. The cost is 500,000. Accumulated depreciation asset 1st April 2019, that's the start of the financial year, is 100,000, and the depreciation rate is 20% of cost, right? And disposal receipt on 30th September 2019 is 400,000. Okay, let's take a disposal account. So this is a temporary account until the disposal takes place. So what's the first step? That's to remove the cost. So the cost is 500,000. Asset account should be credited and disposal account should be debited. I put the answers in thousands here. And the disposal account debited as 500,000. And what is the second step? To remove the accumulated depreciation at the start of the financial year. So that's 100,000. So accumulated depreciation account debit, disposal account credit. Right. And what's third step? Recording current year depreciation up to the disposal date. Right. So they have depreciated the asset until the start of the financial year, and we are going to dispose the asset on 30th September 2019. So that means there's a gap of 6 months, right? So current year depreciation should be only for 6 months period, right? So the cost is 500,000, depreciation rate is 20%. So that means per year the depreciation charge is 100,000, and here we are using that asset only for 6 months. That means for the current period the depreciation charge should be 50,000, right? So that's depreciation account debit 50 and disposal account credit 50, right? So that's third step. And what's the fourth step? Recording the disposal proceed. So disposal receipt on 30th September 2019 is 400,000. So you are receiving that 400,000 in cash. So your cash account should be debited, whereas the disposal account should be credited, 400,000. Now that's all. Now we balance the account. So this side is greater, so altogether 550, and then there's a difference of 50,000. This is the disposal gain or the loss. So how do you recognize it, whether it is a gain or a loss? Okay, so here the disposal account is debited and the corresponding credit entry should be recognized in the P&L. So if the profit and loss statement is going to be credited, that means it's at a gain. So let's say this 50 has been recorded in this side. So that means the P&L account is going to be debited. So that means there's a disposal loss. Okay. So in this case, there's a disposal gain. So that's all about the disposal of property, plant and equipment. So as we discussed earlier, the useful life of the property, plant and equipment is an accounting estimate, right? So changes in accounting estimates is allowed according to the accounting standard, right? So here in some cases, let's take an example. When it comes to a motor vehicle, the initial assessment of the useful lifetime is 10 years. So with the passage of time, the management can assume this asset can be used for more than 10 years, right? The management can assume, okay, this asset can be used more than 10 years of period, and then they can reassess the next economic lifetime of the asset. So that's allowed according to the standard. So as useful life is an accounting estimate, so changes in accounting estimates is allowed according to standards, and it should be adapted on prospective basis. So that means it should be adapted only to the next financial years, right? So those technical terms we'll discuss when we are doing the LKAS 8, changes in accounting policies and estimates, right? Okay, so here is a small example. Cost asset 1st January 2009 is 60,000, scrap value is 10,000, useful life is 5 years. On 1st January 2013, item of 35,000 is added to the asset, and therefore useful life increased by 3 years. Here the useful life is going to be increased by 3 years. So altogether useful life is 8 years now. Okay. So before the reassessment of the useful life, the depreciation charge is how much? So this is based on the straight time basis. So the cost 60 minus scrap value 10 should be divided by useful life 5 years, right? So the depreciation charge should be 10,000 for the year, right? Now 1st January 2013, the useful life is going to be changed. Now the depreciation formula is going to be changed slightly. Okay, so now how much is the cost? So that's 60,000 plus another addition takes place, that's 35,000. So altogether 95,000 is the cost. So how much is the accumulated depreciation up to the reassessment date? Okay, let's calculate that. So we purchased the asset on 1st January 2009. This reassessment takes place on 1st January 2013. So altogether 2010, 11, 12, 13. So altogether 4 years. So per year depreciation is 10,000. So into 4 years, 40,000. Right. So let's calculate the reassessed depreciation. Cost minus accumulated depreciation plus okay. So now the cost is 95,000. I put 95 here, and minus accumulated depreciation plus scrap value. So accumulated is 40 and scrap value, it did not change, so that's 10. So altogether 50,000, and it should be divided by reassessed useful life. So initial 5 years increased by 3 years, so altogether 8 years, right? So your answer should be the answer for this computation. So that's all about the reassessment of the useful life. So that's all about the property, plant and equipment syllabus. So frequently the examiner has not tested separate questions from the property, plant and equipment lesson apart from the company's account. So let's do the company's account question in another session. So let's check the 2017 past paper whether there are any MCQ questions tested on this area. So if you take the 2017 past paper question number 50, which of the following statement is correct in relation to an asset recognized under LKAS 16, property, plant and equipment? So they are asking what's the correct statement. So the number one, it is either a tangible or intangible asset held for use in the production of goods or supply of services. The statement is correct, but only the tangible things. Intangible assets are coming under LKAS 38, right? So that statement is incorrect. And second one, it is expected to be used for a period of more than 1 year. It's correct, but let's check the other statements as well. Third one, it's measured at recognition based on either cost model or revaluation model. Initial measurement cannot be made on the revaluation basis, so it should be only on the cost basis. So that statement is incorrect. Fourth one, all expenditure incurred subsequent to its recognition is always capitalized. No, not all the expenses are capitalized, only the expenses which will enhance the productivity or the efficiency of the asset or the economic lifetime of the asset. And number 5, legal ownership is a necessary condition in order to recognize it as an asset. No, legal ownership is not necessary. There's a clause called substance over form. So the leased assets are the assets that we are using and we capitalize it in our property, plant and equipment even though we don't have the ownership, right? So the correct statement is number 2. Next one, question number 16. Following information relates to an acquisition of a machine on 31st March 2017 by a business. This business is not registered for value-added tax. That company is not registered. Therefore, the VAT component paid at the time of purchasing the asset is non-refundable, right? So it should be added. Price paid inclusive of 15% VAT, 230. So it should be there. Transport cost from supplier's company to the business. Transport cost should be there. Cost of installation and assembly. So it's also a directly attributable cost. Cost of dismantling and removing the old machine. So it should be there, but it's quite doubtful whether that dismantling part is compulsory in order to bring the new asset to the present condition or not. So we can think from the both method. So we can think from the both aspects. And cost of testing prior to the use of machine. So it should be there. And cost of training of employees on the use of machine. No, it's not mandatory. It's not a cost which should be directly attributable to the bring the asset to the present condition and present location. No. So the answer should be 285 or 283. So in 2017, answer number 3 and 4, both answers were given as correct answers. So that's all about the property, plant and equipment. So it covers a major area of your company's account. And in our next session, let's meet with other accounting standards as well. So then hopefully we will be able to cover up a company's account question very recently. So thank you for watching this video and practice with what you learned so far.